Good afternoon and welcome to today's investor webinar with DP Poland PLC. We're delighted to have with us today Nils Gornall, the CEO, and Edward Kacyrz, the CFO. And I'm now going to hand over to Nils to start today's presentation.
Thanks everyone for your time today. So today we'll be going through our 2024 results and then a quick update on our H1 this year and the recent acquisition. As Alex, how do I change that? Okay. As Alex mentioned, we have myself and Edward, our CFO, online today. We'll both be presenting and have a Q&A at the end. So look, everybody, 3 years into our turnaround strategy, and I couldn't be happier. We've had massive growth, and it really has turned the company around. Revenue, we're 80% up. We used 2021 as a base. So the last 3 years' growth, we're looking at 80%, over 3 years. 2024 saw a 20% growth in revenue, so really some really big numbers. Our AWOC, our store volumes, over the last 3 years have increased 45%. Last year, still very strong growth, double digit, just over 13% store growth. System sales, very similar to the revenue, as we're mainly a corporate business at this stage. And then adjusted EBITDA is the big mover, over 300% in the last 3 years, and last year saw a 38% increase in our profits. So you can see we've been improving our metrics across the across the whole network. We've been increasing our volumes. Our NPS scores are heading in the right direction. Customers are loving us more, and our profitability just keeps on increasing. Rollout of new stores. So we ended the year with 118 stores. Now we have over 120, and we're continuing to grow our stores. We plan to have 150 by the year end. Corporate store sell down. Look, now that we actually have the volumes, our stores can be nice and profitable. So we're actually starting to sell down our stores. This is a really exciting part of our business, and I'll talk a little bit more about that later. Foundations for expansion are set. We've got a strengthened balance sheet. We did the acquisition of Pizzeria 105, and our commissary is upgraded and ready to scale to up to 300 stores. H1 performance. So look, H1 was a tough month, as well as April. But we stuck to our strategy, and recent months have been very strong. So momentum's back, and I'll talk about that a little bit later on. But system sales for H1, we're looking at 5% year on year in Poland, and the Croatian market 7%. Like-for-like system sales only 0.5% up in Poland. And Croatia 7%, all the stores are like-for-like. As I said, we continue to open up more stores. We opened up 4 stores in H1 and renovated 3 so far. Franchisee transition, I'll talk a little bit more about that later on in the presentation. And store network expansion. So, we plan to expand to 200 stores, targeting the 150 stores by the end of this year. Edward, if you want to take over the next few slides.
Of course. Hello, everyone. Thanks for your time today, afternoon. A couple of insights to the business from the financial perspective. Our top line growth is the third year in a row, double digit, delivering 20% up on the group revenue. This is a very satisfactory KPI, but most satisfactory is the pre-IFRS and post-IFRS EBITDA, which grow even more versus the previous years. The pre-IFRS EBITDA is positive, is £1.1 million, whereas the last year we ended up the year with 0. Post-IFRS result is very close to 5 million, which is an increase of almost 40%. And what is also very promising for the future is the strength of our franchisees. The percentage margin on EBITDA is double digit. They delivered 11% EBITDA margin with slight 1 percentage point drop versus the previous year. However, in absolute terms, our franchisees delivered almost 8% better EBITDA in pounds than the year ago. And this builds also the base for future expansion and future reinvestments. Nils, next slide. From the P&L perspective, I think Nils said already a lot about the top line. It's a marvelous another year of the growth. But what is important for you as our investors is improving EBITDA and the profits. As you can see on the bottom, let's start from the bottom of the table. You can realize that our loss is only 0.5 million for the year versus the previous year of 5 million loss, net loss for the group. That is mainly driven by the massive improvement around group adjusted EBITDA, 4.8 million. This is from the previous slide. And in the items below the EBITDA, I would say that important element to mention is the other non-cash and non-recurring items. It's almost the costs are almost doubled here, and this is driven by the cost of the acquisition of 105 and some earlier M&A project that didn't succeed at the beginning of 2024. Therefore, this number grew. When we look into the cost above EBITDA, we can see a change versus the previous year pattern. We see some of the lines dropping, some of the lines being in line with the top line growth. Very positive information and very positive also for the future of the business is reduction of the inflation in Poland to below 4% percentage points in annualized terms. We see the materials and energy dropping year on year by 4%, and also we see the external services that are somehow leveling off versus the top line growth that give us the breadth and space for growing EBITDA up. On the other hand, we have two lines which are still in line or slightly higher growing than the top line, which is the cost of goods sold, mainly the food costs, and also the payroll and social charges. Cost of goods sold is mainly driven by the cheese prices. This is something that is a bit exogenous, and we do not have a much influence on this, although we are constantly looking into the potential new suppliers. And after the takeover of 105, we see a big possibility for some synergies here for the success of us and our franchisees. So therefore, this line will be of very close insight on our side. With regard to the payroll and social charges, it is important to say that the minimum wages grew over the last 4 years by almost 100%. That is affecting not only the stores, but also affecting the office. So to keep strong people internally, to reduce the rotation, and also to build the proper structures for the franchise expansion, like the franchise departments, required some additional moves and some additional investments into the team that we believe will pay off in the coming months and years. With regard to the balance sheet, I would say that there are two things important to mention. The first one is the payback of the loan to the Malacan. So at the year end, the company, the group was fully debt free. That builds a very strong position for this year and for the year forward. We will be able to, with the improving bottom lines on the EBITDA and on the profits, we will be able to go for some commercial facilities that can help us leverage the business for the future expansion. On the other hand, we ended up the year with a strong position on the cash, which was more than 11 million pounds. Of course, part of it was invested into the 105 project, but we believe that these are well spent money.
Okay, thanks, Edward. Okay, so Poland. So look, 24 was another big year for Poland. Our operational excellence is definitely paying off. Our stores are now at a level where they can make great profits, allowing us to push the franchise agenda and actually scale the business. As Edward said, our franchisees made 8% more profits in 24 over 23. So we've got the store volumes. Now we've done the acquisition, and we just need to try and convert as many of these stores as we can to the Domino's brand and continue on. So look, I've been CEO here for 3 years, and we've definitely delivered some massive growth. Year on year, 17% system sales growth. Like for like is a crazy 20% year on year for 3 years. Most importantly, we've been growing the sales with volume. So 11% year on year, and like for like was 13% year on year. So now the fun really starts. Foundations are in place, and we're really ready to take this business to the whole new level. We're here to deliver more stores, more sales, and absolutely more profits. Okay, so our constant focus on operational excellence and especially delivery times is simply giving us an advantage over our competitors. Our competitors use aggregators for deliveries. We know all the aggregators in Poland and also in Croatia, plus 40 minutes for delivery. Last year in Poland, we were just under 25 minutes average delivery. So we've got a clear advantage over the competitors, and what we're doing is absolutely working. Digital ordering continues to be a big focus for the company. Last year, our digital ordering increased by nearly 18%, and mobile apps up by 25%. This is a massive focus for us moving forward. The cheapest way to grow sales is with our mobile app. They're more loyal customers. We're not paying the fees to Google and the aggregators, etc. So that is our future, and we're spending a lot of time and energy on growing the mobile app area. H1 system sales, we're looking at 5% or nearly 5% year on year. Like for like, didn't grow too much, 0.5. So we'll go through that later on in the presentation. Edward, if you want to go through this slide.
So as Nils said, we are growing pretty rapidly. Last 2 quarters were a bit small reset of the positions, but we reacted to that in I think a very good way. But referring to the previous years, the growth on top line and also in the volume is driven by 3 important parameters. The first one is the newcomers. We see clearly that our activations of the customers are working pretty well. We have concept or the idea how to bring new customers, new traffic to the business, and convert them and let them stay with our brand. This is 7% up year on year for the new customers. When we bring those people into our doors, we see that they start ordering more frequent, and they becoming a returning customer, which is a very important for the long-term growth of the brand and long-term growth of the business, and will be of a big support also for our new partners from 105 team to build their business and bring their volumes and values to the position where we currently are. As you can see, another 5% increase in the order frequency gave us the possibility to grow from 3.10 to 3.3, 3.4 orders a year generated by the franchisees. Sorry for the y-axis, there is missing one digit from the y-axis description. These are the elements that are working on the volume. The last one is the ticket value. We increased the ticket value for the sake also of improving the profits. We see temporary impact on the volume as well, because this is a natural consequence of the price elasticity for every business. But we went through this exercise already in Croatia more than a year ago. And this is one of important things, but a bit painful at the beginning to go through to improve the profitability. Having in mind the information about, for example, the labor cost growth by 100% over the last 4 years, gives us the perspective that this business cannot accumulate such a big growth forever. And there is a specific moment in time when some of the cost needs to be transferred to the consumers. We believe that we currently build such a strong level of the brand heritage of the newcomers coming to the business and repetitive purchases, that was the good moment before the 105 merge took place. One more slide about the performance of the stores. I think most of you are familiar already with that slide. On left-hand side, you can see the profitability and the structure of the stores over 3 years. On the right-hand side, you can see the volume, which has a big correlation to the profitability. So when we start the business, when we were introduced to the business as a managers, you can see that the structure was not very healthy. Just 1/4 of the business was profitable, and 1/3 almost was not profitable, having a big group of stores being break-even. Right now, we ended up the year with a massive change in the structure. More than a half of the business was profitable, and we stayed just with about 14-15% of the stores being unprofitable, but they were left in our portfolio from the strategic reasons, and mainly because of the low penetration of the brand in some specific regions of Poland, and those regions we believe to boost and penetrate in bigger terms in the coming months or years. This journey gave us the possibility to increase the average EBITDA on every store by about 5 percentage points, from 0.6 to 5.7. These are the bottom squares, blue squares. And you can see that was mainly driven by the AWOC change from 613 to 3 years ago to almost 830 this year. So 200 additional orders per store gave us almost 5 percentage points increase in the business, in the EBITDA, and this is what we plan to focus further. Probably the growth will be with moderate terms on the AWOC, but we will start playing with some other activities to drive the profitability further. Nils?
And so I'll just add to that as well. So the stores that we have that are unprofitable, we have a strategy to move around that. They're in cities where we just don't have a massive presence. There's 5 big cities in Poland. We're number 1 in 3 of the cities, but 2 of the cities we just don't have enough presence. We've only got 3 stores in each area. So, and I suppose that's the beauty of the Pizzeria 105, because they're definitely strong in areas that we're weak. Okay, so over to Croatia. So look, Croatia continued to deliver strong sales. What we've been doing in Poland the last 3 years, we've been doing this in Croatia for the last 5 years. So the brand is strong there. We have a great name. When we open up a store, they're extremely busy. We deliver for the last 5 years. Every single delivery has been delivered on an e-bike. So we're racing around Zagreb on branded e-bikes. There's only us. There's 2 aggregators. So there's 3 people that you'll see flying around on scooters and e-bikes, and we're one of them. So the Croatians know that we mean business, and we deliver. 24 minutes was last year, and like I mentioned, in Croatia we have 2 aggregators, and they're both over 40-minute average delivery times. New product developments continues to be popular in Croatia. We launched the stuffed crust, and the most recent promotion is the volcano pizza, which is getting massive traction. Digital ordering, like in Poland, is a big focus for the company. So sorry about that. There's a massive storm behind us at the moment. Our digital sales grew 17% year on year, and then our mobile app, once again, over 25% increase. H1, we're looking at 7% system sales. All the stores are like for like now, and they're 7%. We have a store that's just waiting to be open. We're just waiting for electricity to be turned on, and we're building our 7th store at the moment. So we should have 7 stores operating in the markets shortly. We continue to invest in Croatia as the brand expands outside of the capital city. We're now going to the coast and some of the bigger towns outside of Zagreb. Okay, so the big one is our acquisition. So in Q2 we purchased Pizzeria 105. It's 90 stores, 100% franchise, 76 franchisees. You know, now that we've owned this business for a few months now, we've looked into the business, and it's a great business. It's got great people, great franchisees, and we're really happy with our purchase. It's cash generative, and it's, you know, adding to our profits while we try to merge the two brands together. You know, right now we have over 200 stores under the two brands. So we've got the store count. We've got 76 amazing franchisees. Now we just need to try and convert as many stores as we can so that we can become one brand and become even more powerful as one. I think together, you know, we will be number one in Poland, and that's what we're trying to go for. As expected, it will be a 2-year project. There's a lot of work to do. We've just about to launch our first 5 pilot stores. So we've been the last few months we've been speaking to the staff in their head office. We've been meeting all the franchisees. We've been listening, learning, and we're taking the best things from their business and bringing it into our business. So there's already been some learnings that we've made the changes in our business already. And then we'll be launching a different menu going on, you know, what's been happening in Pizzeria 105. So I think we've got some really good synergies and some nice advantages to bring to our business. You know, the founder of Pizzeria 105, you know, he grew this business from 0 to 90 stores. He's a very smart fellow, and he's helping us, you know, take this business to the next level. So we have 5 pilot stores. They'll be launching by the end of this month. And then we'll be testing, you know, we'll be sitting there testing it for 4 to 6 weeks, make sure we're happy with the model, make sure it's all working. And then, you know, from September, we'll start inviting our Pizzeria 105 franchisees to convert. And you know, our goal is to try and convert 1 store every week, and until we've done as many as we can. Okay, integration and store growth. So with a combination of organic store rollouts and the Pizzeria 105 converted stores, we're aiming to finish this year with 150 stores. You know, the focus will be on growing the volume in the rebranded stores. So basically, the Pizzeria 105 store volumes are where our Domino's stores were 3 years ago when I first arrived. So that'll be the big opportunity for them. You know, we've got the Domino's branding, we've got the national advertising strategies that's worked over the last 3 years. You've just seen that we grew double-digit, 20% year on year. You know, that's what we're expecting and we're trying to do with the converted 105 stores, so we can really bring value to our new franchisee partners, so they're doing more sales. And what's most important for them and us is that they're making more profits. You know, we have a big presence on the aggregators. We have the e-commerce, we have our mobile app. So we've got a lot to bring to the business, and you know, we're expecting to rinse and repeat exactly what we did in our Domino's stores in the converted stores over the next few years. So I think there's a lot of upside for the Pizzeria 105 franchisees that want to convert and join the Domino's family. You know, we just can't wait to get started and show them exactly what we can do. Franchisees own stores. Look, there is going to be a rapid shift towards the franchisee ownership over the next 2 to 3 years. It's driven by mainly the Pizzeria 105 franchisees coming into the system, but also with our corporate store sell downs. So in H1, we've sold another 5 stores. Last year, we sold 5 stores to internal staff. This year, we've sold another 5 stores to internal staff, and we have a few more planned for the rest of the year as well. So, you know, that's working really well. There's quite a vibe you know, within the company. You know, the internal guys that have bought the stores, you know, they're making good profits, and everybody else can see that. So it's a really exciting time for our business, and especially for, you know, staff that have been here and working for DP Polska for the last 5, 6, 7 years, and now they've got that opportunity to become a young entrepreneur, and they're making really good money. You know, as Edward said, our franchisees last year were 8% more profits than 2023. Okay, so our 3-year outlook. So we want to double the sales in 2027. Seems like a big number, but if we can convert as many stores from Pizzeria 105, this is the number we should be hitting. So, this will be through organic store growth. Although we've taken the foot off the pedal with that, we still are opening up new stores. Like-for-like sales growth. Yes, we're not growing at double digit, but we're still expecting single digit sales growth. And then all of the 105 conversions that will come over and add to our Domino's sales. So the system sales here is just the Domino's pizza. We haven't included the Pizzeria 105. Number of stores, like I said, we currently have 210 stores under the two brands at the moment. And then by 2027, we expect to pass 200. That would mean that we'll pass Pizza Hut sometime next year and we'll become number one, passing the local pizzeria, hopefully in 2027. Franchisee share, this is the most crucial part of our strategy and why the Pizzeria 105 M&A was such a good purchase. I think by the time 2027, with all the franchisees coming over, and plus the sell downs to our internal staff, we should be over 50% of our business should be franchised. And speaking to a lot of the Pizzeria 105 franchisees, I think there's a lot of growth within that community as well. So, there's lots of interest. They just want to convert their store, see how it goes, and as long as we can prove that they can make more profits, we've got plenty of indication that they will want to buy more of our corporate stores. So hopefully we can do better than this, but this is a target that we've got for now. Okay, so 2024 summary. So look, it was another year of significant growth, and it really has positioned the business for long-term success. H1, so I'll go through that now. Look, it was a very tough Q1. April was just as bad. The consumer sentiment in Poland at the start of the year was quite bad. There was a lot going on politically within Poland and around the world, and that really affected the consumer sentiment here in Poland. Look, we stuck with our guns, and May and June delivered a significant turnaround. May was the busiest month we've ever had in the history of the company. And when I say that the first 12 months was a struggle, it was still the busiest January we've ever had. It's still the busiest February the company's ever had. Still the busiest March and the busiest April the company's ever had. We're just not growing at that double-digit like for like. As Edward said, we did have to take a little bit of price and pass on costs to the consumer, and that has affected our sales growth. Croatia continued to grow at good growth, 7% year on year. And like I mentioned, we've got 2 more stores just about to open as well. Profitability is improving. We now have a debt-free balance sheet, as Edward suggested. We did the successful fundraise, providing capital for the next stage of our strategy. Our commissary is upgraded and ready to consolidate from 2 sites into a single site. So we'll have 1 central facility commissary looking after the whole of Poland. So expect to see some savings coming through in April 2026. And then the acquisition of Pizzeria 105, bringing scale to the business quickly. Market opportunity. Look, Poland's a great place to do business. It's currently one of EU's fastest growing economies, with rising disposable incomes, very low unemployment. People are working longer hours. There's dual income households, catching the West fast. It's all fueling demand for freshly prepared, delivered food. And that's the business we're in. So it is a great place to do business. And yeah, we're really excited to grow from here. Market position. We want to be market leader. And once we have over 200 stores, we should be market leader. This gives us greater leverage with our suppliers and also our pricing power. System sales growth, like I mentioned, we want to double the sales within 3 years. New store rollouts, like-for-like sales growth, and then the conversion of many Pizzeria 105 stores as we possibly can. Growing national ad fund. This rapid growth also has a huge impact on our national ad fund. We contribute 4% of our top end sales from around the country into our national advertising fund. So double the sales, we double the advertising. Once we have 200 stores, we can go on TV. We can start to sponsor, TV shows or sports clubs, and really take us to that next level. And then, most importantly, this is the big game changer for us. Is the shift from corporate to franchise stores. So many advantages in this. It frees up capital so that we can reinvest into new store openings. Faster scalability. This country, it's got nearly 40 million people. We should have 500 plus stores. We're never going to get to 500 stores without our franchisee partners. With 80 franchisee partners, if half of them just build a store per year, that's how we can really get some faster scalability and get to that 500 mark. So this is super important for us. Growth funded by the franchisee, not just us. We'll all be growing this business. Leaner corporate structure. This is a big thing from the Pizzeria 105. They own 90 stores and have a very small head office. In Domino's world, because we're all a corporate business, we have a lot of support staff. So, we have a lot of staff in our head office, and as we become more franchised, then we can have a leaner corporate structure. More stable earnings. So, stable earnings for franchisee profit streams. It is much more easy to predict than a corporate-owned business. And that's mainly because franchisees have skin in the game and just have better results and more consistent results. So that is definitely the future that we need to go into. Profitability with all the key growth drivers moving in the right direction. We're confident we have a great business on our hands. Come 2027, we're doing over 100 million pound in sales. We've got over 50% franchised, and we've got over 200 stores. It's a really, really good business. And that's it for today. So we thought we'd run through that nice and quickly, open it up for Q&A, and we can go from there.
Fantastic. Thank you, Nils, and thank you, Edward. We are now going to take questions, and if you do want to ask a question, please type it into the chat box at the top or bottom of your screen. We've had a couple of questions that have come in, so let me start with those. First question here. How does DPP make its money? Is it selling the ingredients and taking the slice of the revenue?
Okay, so we at the moment we have several income streams. We own and operate corporate stores, so a lot of the profits come from our corporate stores, and then from our franchise stores, we have two profit streams. We own and operate our commissary, so we're selling down the food to the franchisees, and we have a franchise royalty fee.
Okay. Second question here on the Pizza 105 acquisition. Is there a push to get the Pizzeria 105 franchisees to take over the company-owned DPP stores, and how does the financing work?
Absolutely, yeah. So that's our big hope. We want our new franchisee partners to grow. We know that this business is scalable. It's the McDonald's of pizza. So we have systems. You can own and operate more than one store. So we think there's a big opportunity for our new partners to buy our stores and basically grow their business. We have banking partners here in Poland. So the franchisee can go to the bank with a deposit, and the rest can be financed.
Thank you. And then the third question we have is, how far away is DPP from being a financially established DP operator?
A DPP operator?
Well, I guess they're asking the question, how far away are you from being similar to a financially established Domino's Pizza operator?
Okay, cool. Yeah, look, you saw our targets. I think 2027, once we've hit that 200 store mark, over 50% franchisees and doing 100 million pound, that's starting to be a really good business.
Thank you. Next question. Do you manage currency differences, and what is the rationale for your approach on this?
Edward, do you want to take that one?
Yeah, we manage the currency differences to some extent, but because most of our business is run in Poland without the impact of the currency exchange, then our biggest effort during the last year was to have a transition of pounds sterlings taken during the fundraise from USA investors and convert them to Polish zloty with the best exchange rate. So when this money are already in Poland, let's put it this way, then this exposure to the exchange rates are relatively small. So therefore, we cooperate with our bank, and on some preferred terms, we have a currency exchange.
Thank you. Moving back to the Pizzeria 105 stores, raising Pizzeria 105 stores revenues to DPP levels is key. Will this be by increasing AWOC or prices or both?
It will be increasing their volumes. So basically the store volumes of the Pizzeria 105 is exactly where the Domino's was 3 years ago. So like I mentioned before, we'll be using all of our tricks in the bag, our e-commerce, the power with the aggregators, our marketing, we're very good at marketing, and our marketing national ad fund, where there's a big pool of money. So I think the combination of those will bring big volume increases for the converted stores.
Thank you.
Lots of opportunity for the franchisee partners.
Thank you. Next question here is on current trading. January to April was tough, with May and June much better. How confident are you that May and June are more indicative of the future than Q1 was?
Look, like I mentioned, it's still a record. Every month has been bigger than the year before. So, I suppose we need to put it into perspective. Yes, we're not growing double digit, but we've still got a very healthy business. We don't like negative customer counts at all. So, we'll be doing everything in our power to turn that around. Since May, it's been very positive. So yes, confident we'll end up the year with some good single digit growth.
Thank you. Next question here. When will DPP be free cash flow positive or net income positive? And what are the economics when you sell a corporate store to a franchisee?
Go for it, Edward.
Yeah, so with regard to being the net income positive and free cash flow positive, we are still in the very strong expansion mode. And you can see on the EBITDA level that we are improving our profit massively. Even the net income, net loss this year has been improved massively versus the previous year. From that perspective, this is just about also the matter and discussions whether we want to grow or whether we want to accumulate the profits. We are not in the position to accumulate profits. We are in the expansion mode constantly. So from that perspective, we rather prefer to reinvest the money back to the business, either in the form of the investment into the digital or commissary or new stores, so that we will build the snowball to grow the business and see a strong return within 2, 3, 4 years from now. And regarding the franchise economics, when you look at our business, we can divide the profit centers by 2 elements. The first one is the EBITDA that is done by the franchisees or by the store. And the second part is the EBITDA done by the company on food cost sale, on the sale of the food, on royalties. These are, let's put it this way, the main drivers. So whenever we sell the store, we have, of course, the exposure to lose the EBITDA that the store itself is generating. But from the overall perspective, the store that is sold has the potential to improve their top line, improve their EBITDA, build the positions where this franchisee can open another store. And with this approach, we will have, as a company, as a Domino's, a quick return to the commissary revenues and commissary profits by the sale of higher volumes to those stores. And on the other hand, the transitions from the corporate stores to the franchisees give us room for restructuring of our G&As on the office side. As you can see in our P&Ls or in our communication in different surveys or market notes, you can see that the G&As are still rather high. But with the transformation of business to franchise-led organization, the G&As is big areas, or the overheads are the big areas where we can seek for a massive release and a reduction so that the EBITDA will grow.
Thank you. Next question. There are a lot of moving parts re the cash. You've had the rights issue, Pizzeria 105 acquisition, new stores, selling stores, funding franchisees, etc. What are net cash balances now, and what sort of exceptional costs are likely? What might the cash be by the year end?
I think I cannot answer this question so strict because this is about our future, and this is not something that we can release in details. I can say that we still sit on decent cash position from the fundraise. Our business is month on month for the last couple of months EBITDA positive, so we generate cash from the operations. We are debt free with a growing business, so from that perspective we also have a possibility to go for the loan facility that will let us leverage the business. So from that perspective, I would say that we are cash secured as a company.
Thank you. Next question here. Can you please speak to the 30% of Pizzeria 105 stores that overlap with existing Domino's Pizza stores? What is the contribution to Pizzeria 105? And what are the mechanics of merging those with Domino's Pizza stores? E.g., will the Pizzeria 105 franchisees be invited to take on the respective DP franchisees? And are these likely to look like regular franchise sales or transactions? Thank you.
Yeah, exactly right. When you have an overlap, we'll be inviting the Pizzeria 105 store to take over our store and merge the two. I mean, we're not going to have two, you know, we can't convert a Pizzeria 105 to a Domino's and have two Domino's on the one street. So that's exactly what we'll be doing. We'll be inviting the franchisee to join the Domino's business, and then we'll decide which is the best lease. We'll take down one of the stores, and then that franchisee will run both stores' sales under one roof. So for those franchisees, they'll actually be getting even more of a bonus because there'll be a lot of sales coming from our stores. I hope that answers the question.
Yeah, no, thank you. You mentioned that quantity was hit by price hikes. Was this a surprise, especially the extent to which it happened? And have there been any other negative surprises in the last year or so?
Yeah, go for it, Edward.
I would say that this is not like the only answer that we have for the loss or for the drop in volume.
Yeah,
because
exactly
as Neil said, the end of the year and beginning of the year, there were a lot of political turbulences, especially with the way how, for example, President Trump communicated to the world about the Ukraine support and so on. So from that perspective, don't forget that still in Poland, we have about 2 million of Ukrainians sitting here. And it's maybe not relatively easy, but there is some way of shaking the community in general. So there was some drop in the consumer confidence to spend money. Of course, there was an increase of the prices, which definitely is a part of the impact. But there were also drops in other sectors and businesses. We did such analysis for the FMCG, for example, food and non-food businesses with our fellows, colleagues from different other sectors. And they also got a big hit at the beginning of the year with the consumption there. So from that perspective, definitely price increase had something to do with the volume drop, but I equally could say that without the price increase, we would see a volume drop anyway, probably with a lower level.
Okay, thank you. Next question here. It appears that AWOC growth is slowing as you push price rises through. What are your expectations for AWOC for 25 and 26?
Yes, so yeah, look, the AWOC growth has slowed down, but you know we're happy with our volumes. I think our franchisees have proven that our volumes, they can make good money with a 3-year payback on building a new store compared to their profits. So I think in that regard, it's fine. We expect to grow the AWOC as single digit, continuing through. You know, we did the same exercise. I think Edward mentioned before, we did the same exercise in Croatia, pushing a little bit of price. It's a little bit of short-term pain for the long-term success. So, that's what we're expecting, to keep on driving the store volumes, not a double digit, but at a nice profitable single digit growth.
Thank you. Got a couple of questions here on Pizzeria 105. I think you answered one of them in the presentation, but let me ask it anyway. With regard to Pizzeria 105, when are we going to see the first conversions to the Domino's brand, and how many are you expecting to convert by the year end? And the second question on Pizzeria 105 is, how do current sales per store compare to your existing Domino's stores? And is there a reason why this gap cannot be closed?
Yeah, absolutely. So we'll start from the backwards. So yeah, there is no reason why the gap can't be closed. So, we're super confident. I think we've proved for the last 3 years what we've done with our own system sales. So absolutely, I see absolutely no reason why the Pizzeria 105 stores, once they're converted to a Domino's, won't see that same sort of growth. As far as when we're starting, so the first pilot store will be set for the 28th of July, so a couple of weeks now. We've got 5 pilot stores, and then we expect to start the rollouts. We've got lots of interest at the moment. We want to make sure that we've got the system. We know exactly what we're doing, so we can do it as fast as we can. So the goal is to start at the start of September, and then we'll try and convert as many stores as we can by the end of the year. But this is not just by the end of the year. We're going to be doing this all of next year as well. So I'm sure we'll get better and better as we go along. We've got a big goal of a store a week. We'll see how we go. But if we don't achieve that at the start, we will get better and better as we go. Practice makes perfect. So yeah, we've got a lot of work to do for the next year and a half.
Thank you. We've got a couple of questions here on financing store expansion.
Yes.
So I'll combine them into one. You spoke about investing profits back into the business. How will you expand? How will you finance your store expansion? Will it come from profits, cash in hand, or debt, or equity issuance?
I would say the following: that definitely first is cash in hand. Second thing is the cash generated from operations. Then I would think about the commercial leverage with some loan facility or some overdrafts if needed, because that's business-wise potentially cheaper and better also for you as an investors. Do not expect any dilution at this stage, and no one takes it into consideration unless there will be another big project to take forward. But this is not that time. We have enough eggs in our basket to deal with, and we need to do it correct so that you are happy with the results. Did I miss something, or I answered the whole question, Alex? Sorry for that.
No, I think you covered it there, Edward. So thank you for that. Got a question here on the operations and specifically the mobile app. You talk a lot about how important the mobile app is in terms of driving sales. Can you give us a little bit more information on the mobile app and what it does?
Yeah, absolutely. Look, you got the mobile app, that is more customer loyalty. We can send nudges for free, and then we pay no acquisition fees. So, the other way we bring our orders through the system is through the aggregators, and we have to pay them a fee. Through digital marketing, and we have to pay Google a fee. If it's through our call center, we've got to manage our call center. So those 3 streams, there's a fee for every order. On the mobile app, there is no fee. So that's the future. That's what we're trying to do. We can see a lot of growth in that. We know what the other markets are doing, and we're basically trying to gather as much information and learn from our neighbouring markets, because I think we've got a lot of catching up to do in our mobile usage.
Thank you. I think we've got time for a couple more questions. So let me ask these two, and apologies if we haven't been able to cover every question. I think we've done most of them, but there may be a couple outstanding at the end. But let's try 2 more questions in the time we have available. And the first one is, are there any fast food competitors that concern you?
No, I mean, competition's healthy. We're in the pizza business, so there's no new competitors coming along. We've got the Pizza Hut, that's mainly in the shopping centres. They use the aggregators for deliveries. The other competitors are local brands, and we've got a Russian brand called Dodo. I think they've got 4 or 5 sites. So it's the local guys, and it's Pizza Hut. So the number one is De Grasso, and I think we've got some good plans moving forward with with how to grow franchisees within our business so that we can overtake De Grasso as well. As far as the other competition, the McDonald's in Poland is very, very, very strong. KFC is very, very strong. So they're already strong players. So the competition are here. We're taking market share at the moment, and we're pretty happy about that. So simple answer, we're always looking at our competitors, but they're here. So.
But guys, from that perspective, we need to be clear. We want to be the leader of this market in 2-3 years. That means that we of course need to look into the competitors, what they do, but we need to also the settled rules for this sector, how we want this business to develop, and this is what we are concentrating. We are not just looking on the competitions and copy paste what they are doing. We are just looking on our markets, Domino's markets in the world, what they are doing best, and try to copy paste it to Poland, so that we are always 1-2 steps ahead of our competition, and this is our concept for the future.
Exactly right. Like especially with the delivery times, there's for the aggregators and our competition to start delivering in 25 minutes, from the 40s they're in at the moment, is absolutely massive. So, we've got a clear advantage, and that's why we're growing.
That sort of links to the last question, and 2 people have asked this, so I thought I'd ask it, which is, can you comment on customer satisfaction? What is it now, and how has it changed?
So I think last year, I don't have the official numbers for last
38,
year.
if I'm not mistaken. Last year was 38. This year we are 45, so it's 7 points up. I would say we are stabilizing somehow, yes. So it's like we went through the process of low-hanging fruits absorption and grow the business. Now we are going into the mode of more sophisticated business. So potentially grabbing additional points will be more and more difficult, but definitely this is not the end where we want to be.
Yeah, exactly right. I think where we are, where we've got presence, we have great NPS scores. We just need more stores, and we need critical mass around the whole country, and then that's when the brand will just go to that next level.
Great. Thank you, Edward, and thank you, Nils. That brings us to the end of today's presentations from DP Poland.
Thanks, everybody. Thanks for your time.